Hello, my name is Eli Yim. I'm an attorney here at Beresford Booth in Edmonds with the business and corporate group. Um, my particular practice also includes mergers and acquisitions, contracts, all sorts of transactional work, real estate, employment law, um, a lot of the things that municipal compliance, things that are transactional in nature. And so, as you might imagine, then many times my work will overlap with or involve tax issues. And so, we have been following the happenings in Olympia this session, where the legislature has proposed changes to both the capital gains and the estate taxes in Washington. And so, just wanted to take a few minutes to talk about these proposed changes and what they might mean if they are to, in fact, become law. So, what we're going to look at today is the language itself of the engrossed substitute Bill 5813, then the actual proposed changes to the capital gains tax and the estate tax. And particularly with the latter, we'll actually plug in some numbers and see what those changes, practically speaking, mean. So, first of all, status update. As of this recording, the bill has passed both chambers of the legislature and it sits on the governor's desk. Now, this is the little handy dandy bill status at a glance graphic that they have on the legislative site website. You can see here engrossed substitute bill 5813, and it's been delivered to the governor. Um, the governor has not yet acted, and I believe he has 20 days. They did not, it did not get to his desk until April 27th, which I think was also the end of the legislative session. And so he has 20 days to act on it. Um, he can sign it, he can veto it in full, or he can veto part of it, or he can take no action at all. So he has until, my math is correct, May 20th or so to take some sort of action. And unless he vetoes it in its entirety, some or part of it becomes law. So we will have to see, but that date is looming. In the interim, just to kind of get a better sense of what the bill um, is about, here's the purpose. Really, there's three parts of it, and I've broken them all down. The first thing is the legislature has an express purpose to try and generate more funding for education. Um, Kind of a second goal here stated in the bill itself is to create a more progressive rate structure, and I'll talk about what that means in a few minutes. And ultimately, to do this, to work through the capital gains tax and the estate tax structures. So here's some of what the legislature cites as the reasoning behind finding more funding for education, that it is paramount duty of the state to provide adequately for every child's education in Washington. Um, it cites that in 2024, that when given the opportunity to look at things, that 64% of Washington voters and in a large majority of counties voted to uphold the excise tax previously and dedicate the revenues from it for the education legacy trust account. And so the legislature is planning to continue that funding and has expressed that purpose here once again. So second goal we talked about briefly there in one of the purpose points is to create a more progressive tax structure. Um, Washington historically is one of the worst, most regressive tax states in the country. And so looking at the graphic here on the right side of the screen here, the total taxes, you can see here 13.8% of the lowest 20% income earners income goes to taxes. So just to take a step back here, um, when we talk about regressive taxes or a regressive tax system, basically we're saying it is a tax system in which the lower income residents pay a larger percentage of their income to taxes. And so, in other words, they disproportionately are burdened and impacted by your tax system. And so that's what this bar graph shows here. 13.8% of your income, if you are in the lowest 20% of earners, goes to taxes, whereas the top 1%, only 4.1% of their income goes to taxes. So, triple the impact if you are in the lowest 20%. And if we were to look nationally, I mean, well, let me take a second to discuss this as well. I mean, one of the reasons for this, we do not have in Washington a state income tax. And so instead, we have a really high sales tax, really high gas tax. We have taxes on specific goods like alcohol and tobacco. We have business taxes that ultimately are passed on to the consumers. And well, when you pass costs on to the consumer, again, the higher income people are not being taxed at a different rate. And so when you have those kinds of taxes being applied across the board, it is going to disproportionately affect lower income earners. And so that's what we're seeing here. And that's kind of the hallmark of a regressive tax system, right? Where it's not geared at all to income and instead kind of just disproportionately affects those who make less money. And so again, on the left side of the slide here, you can see where we fit in as Washingtonians nationally. For many years, Washington was number one as the most regressive tax state in the country. Florida has now beat us out for number one, but Washington is number two for all the reasons that we talked about before. And so these are some handy graphs, graphics and graphs that are from the Institute on Taxation and Economic Policy. Anyway, something to keep in mind as you enter into some of these conversations around state level taxes. So the goal here is to have a more progressive tax, one that would place a larger tax burden on higher income earners. And so the capital gains tax is pretty straightforward here. Everyone gets a standard deduction of $270,000 for tax year 2024. And there are other deductions. So if you've got a sale of a qualified family-owned small business, there's a deduction. Charitable donations in excess of $270,000, there's additional deduction you can take, but it cannot exceed $108,000. So here's what we're talking about as far as the change in the proposed change in the capital gains tax. So no tax due up to the standard deduction amount. So you can see currently doesn't change, right? So they're going to keep that $270,000 threshold. Beyond that, under the current policy, everything beyond that is taxed at 7%. Now we're going to be taxing anything over $1 million at 9.9%. So a 2.9% tax increase on long-term capital gains of over $1 million. A couple of things that we hear all the time from people, right, as we talk about capital gains, right, this can be a sizable burden. And when you look at these dollar figures, where do people become most wary when they see these dollar figures that approach $1 million or exceed $1 million? They wonder, when it comes to most people's single most valuable asset, their home or some real estate, they wonder if that will be impacted or if that is impacted as long-term capital gains under the state capital gains law. And the answer is no, there is an exemption, right? So all real estate transferred by deed, real estate contract or judgment is exempt from the state capital gains tax. And you can read these bullet points and see some of the other exemptions. The other one that people may be curious about. Also, assets, the third bullet point, assets that are held in certain retirement accounts are exempt. So your IRA, your 401k. When we talk about retirement accounts, those are exempt from the state capital gains tax. Curiously, there are other exemptions for regarding livestock, timberlands, commercial fishing privileges, and the goodwill received from the sale of an auto dealership. Just to keep that in mind, if that is relevant to your capital gains question. All right, so that's the capital gains tax. Pretty straightforward. 2.9% increase above $1 million. The estate tax is a little bit more nuanced, only because I think there is a tendency to get fixated, especially with the idea that we're trying to create a more progressive tax structure, that we're going to be interested in looking at the tax rates as we kind of go further and further up. But really, the most important point, I think, here with the bill that's on the governor's desk is that it proposes an increase in the exclusion amount for the estate tax. So what do we mean by this? So this is the dollar threshold up to which there is no tax due. So if under current estate tax law in Washington, if your estate is $2.193 million or less, you are not subject to an estate tax. The proposal would raise that threshold to $3 million for all deaths occurring on or after July 1 of this year. And it would be adjusted per inflation beginning in 2026. Okay. So we're seeing an increase in $807,000 in the exclusion amount. And as we plug in some numbers here in a little bit, you'll see why that is probably more significant for most people than the actual increase in tax rates, estate tax rates. Okay, so here's an example of the table and what I'm talking about with rates. I want to make it clear, first of all, that this first column to the far left, these dollar amounts are not the dollar values of your estate. These are the amounts over the exclusion. So this up to $1 million, here in the middle column, these are current tax rates, and the far right column are the proposed tax rate increases. So this first column, up to $1 million, means if you have an estate of up to $3.193 million currently, so that would be $1 million over the $2.193 million exclusion amount, then you are taxed at a rate of 10% on those funds over the exclusion amount. So again, these numbers are not the total value of the estate. They're the amount of the amount that you are over the exclusion amount, over the exclusion threshold. So up to $1 million takes you up to 3.193, up to $2 million takes you up to 4.193, and so on and so on. And you get taxed. With each next step, you get taxed at the rate you see here. So that's number one, is understanding what we talk about. When we're talking about the taxable estate, we're talking about the amount over the exclusion. The second thing to look at on this slide is just what the proposed change is in tax rate then. So you could see pretty straightforward for the first couple of steps on the chart, staying the same, first $1 million, 10%, 1% increase for the next $1 million from 14 to 15%. It isn't really until you get to, I guess maybe we would say, a 3% difference between $3 and $4 million taxable estate, $4 to $6 million, a 5% jump on those at that step. And we really see then some sizable jumps here, 6 to 7, 7 to 9, and then beyond that, a 35% tax rate at $9 million plus of taxable estate. And so you can see then that is a much more, I mean, was already going to be progressive, but they have really tried to tax the higher estate values at a much significantly higher rate. And so let's just take some examples then. If we were to look at an estate of $3 million, you can see here under the current law, with the exclusion of 2.193 million, there is a tax rate of 10% up to $1 million over the exclusion. So we are $807,000 over the exclusion amount. That puts us in this step. The tax at 10% is $80,700, and that's your total tax. With the increase to $3 million for exclusion, there is no tax, right? We a state of 3 million, we're right at the edge of the excluded amount. So that's a significant savings. What about an estate of $5 million? Okay. The one thing on this chart, basically, as you go up to each step, you take, this is the tax amount on the previous step. So we go from $2 million over. That's the tax from step 2. And then we're going to get taxed at this level 15% of whatever you are over the $2 million level. So in other words, at $5 million, you are $2,807,000 over the exclusion amount. So the $2 million puts you at $240,000. And then you still have to tax the remaining $807,000 in this step at 15%. So we take that, we add it, the 240,000 from the first 2 steps, we add the tax of 15% at this step on the remaining taxable estate, and we get $361,050. With the $3 million exclusion, we are $2 million at $5 million. We are $2 million over the exclusion threshold. So 10% for the first million, there's the 100,000. And then for the second million, 15%. So there's the 150,000 for a total of $250,000 in estate tax. So you can see now we're at $5 million of an estate, taxable estate, of an estate. And just doing the math here with the taxable estate over the exclusion amount, under the proposed bill, there would be a significant savings just by virtue, honestly, of the higher exclusion amount. So it would be $111,050 less than under the current law. How about $7 million? We do the same math and we get a total tax of $695,260 under the current law with an exclusion of 2.193 million. $7 million estate under the proposed bill, 610,000. So still less. And we're all the way up at $7 million now. So just to jump ahead, if we were to look at 10 million, we finally have kind of changed or flip-flopped here in which taxpayer under the current regime or the proposed regime would pay more. We finally have flipped things around where under the proposed rates, you would pay more in estate tax. And that flip, I think, takes place right around a $9 million estate, where I think there's only a $7,000 difference in tax at a $9 million on a $9 million estate, where you would pay $7,000 more under the proposed bill than under the current rates. So it's all of this is to say that the big news, we may see, if it does get signed into law, coverage talking about the higher rates. But really, I think the numbers kind of bear out that the more important story would be if the higher exclusion amount goes into effect. And all of this is to say that in any of these things, we've got a team of experienced attorneys here to talk about any sort of business uh, or corporate law questions, but more importantly, we can also help with estate planning. These tax issues will always be part of the analysis that you would want to do and consult with a CPA and an attorney about if you think that there is some way to mitigate, because we're still, even though we're talking about these tax rates and looking at these high numbers, um, there are ways to plan to soften the tax burden in any number of strategies. So uh, all of that again, and more that we can help with here at Beresford Booth. If you have any questions, there's my contact information. Feel free to reach out to us, and we will do what we can to help. Thank you very much.